Imagine reporting a massive surge in profitability, boasting some of the absolute highest margins in the entire software sector, and then watching the market completely crater your stock anyway. That is exactly the massive disconnect we saw with AppLovin on August 6, 2026. Today, we're diving into a fascinating financial paradox. We are going to look under the hood of an incredible AI engine, explore a multi-billion-dollar valuation gap, and figure out what the market is actually pricing in right now. Let's dive right in.
Immediately following their second quarter earnings release, AppLovin's stock basically fell off a cliff. It crashed nearly 20%, hitting a 52-week low of $332.19 in a single day. We're talking about billions of dollars in market value wiped out in hours. Now, when you see a sudden drop like that, your first instinct is probably that the underlying business must be collapsing, right? Or maybe revenue is in free fall. But that couldn't be further from the truth.
Because right next to that brutal 20% stock crash is this number, 84%. To be exact, AppLovin had just reported a massive 83.9% Adjusted EBITDA margin. And if that wasn't enough to make you do a double take, they also posted a 64.1% surge in net income from continuing operations compared to the same time last year. So the tension here is absolutely wild. We have a company printing cash at historic levels, yet investors were rushing for the exits. To understand why, we first need to understand the economic engine that actually drives this business today.
Part 1. The core advertising engine.
To figure out how AppLovin makes its money, we have to look at a massive structural pivot they just completed. Back on June 30th, 2025, they sold off their legacy gaming apps division for $400 million in cash and a 20% equity stake. They basically decided they didn't want to make games anymore. They wanted to become a pure-play, asset-light advertising technology powerhouse. And the absolute brain behind that powerhouse is called AXON. This is their proprietary deep learning neural recommendation engine. It operates in real time to match advertisements with highly targeted consumer profiles. And guys, it is incredibly effective. In this latest quarter, even though their absolute installation volumes dipped by a minor 2%, the AXON engine drove a massive 58% year-over-year surge in net revenue per installation. They are completely offsetting volume dips by expanding their core pricing power and predictive efficiency wildly. But as we all know, an AI is really only as good as the data feeding it. And this chart right here brilliantly illustrates their data moat. This is the market share for their programmatic ad mediation platform, known as Max. In 2026, AppLovin Max mediated 73.1% of the top downloaded apps that utilize in-app advertising. Google's AdMob and Unity's Level Play are trailing significantly behind them. This scale feeds a powerful self-reinforcing data loop. You see, billions of daily transaction events flow through Max, and that continuously trains the AXON neural networks. Because it's integrated directly into the core code of thousands of apps, the switching costs for developers are incredibly high. It's an institutional lock-in that's just crushing their competitors.
Okay, so we have a dominant market share, an incredibly lucrative AI engine, and literal 84% margins. So what exactly spooked the market? If the moat is this deep and the cash is flowing, why on earth did Wall Street panic? This brings us to the central conflict of our story.
It basically all came down to a brief pause in momentum. During the Q2 2026 earnings webinar, CEO Adam Foroughi explained that sequential top-line growth decelerated to 4%. Why? Because of a model timing issue. They were deploying deep architectural updates to the AXON algorithm, and it took slightly longer than projected during the quarter, which delayed the performance lift they were expecting. Now, those updates did go live in early July and immediately accelerated ad yields, but the damage to the second quarter was already done. The bear case here is actually pretty simple. When your valuation is entirely native to flawless AI execution, any delay, even just a minor algorithmic pause, terrifies investors who are demanding perfection. Turns out, Wall Street isn't very patient when the money printing machine pauses to update its software.
Part 2. Earnings, evidence, and scorecard.
Let's look at the evidence and see how this all builds into the broader Q2 2026 financial reality. We really need to separate that temporary algorithmic delay from the actual underlying cash generation of the business. Let's look at the numbers announced on August 5th, 2026. AppLovin brought in $1.92 billion in revenue, which is a 52.8% increase year over year. Adjusted EBITDA hit a massive $1.61 billion, and free cash flow for the quarter was a really healthy $863.3 million. They also posted GAAP diluted earnings per share of $3.76, which actually beat analyst estimates. I mean, look, these numbers are phenomenal in a vacuum, but Wall Street expectations were sky high and revenue narrowly missed the consensus projections of roughly 1.94 to 1.95 billion. It was a very solid quarter, but clearly mixed against those highly elevated expectations.
But when we step back from the single-day stock volatility, the fundamental business quality is undeniably elite. Look at this qualitative scorecard from the research. They score a perfect 10 out of 10 for profitability. Revenue quality is a 9 out of 10, mostly thanks to that transition to a pure ad tech model. Financial health is a 9 out of 10, carrying over $3 billion in cash against their long-term debt, leaving them with a near-zero net leverage position. The blended overall score is a highly impressive 8.6 out of 10. The underlying engine remains structurally dominant.
And by the way, if you like deep, evidence-based breakdowns like this, you should know that all the research behind this video was created using Flash by StockSentinel.ai. You can actually generate deep research reports exactly like this one for literally any public company in the world, completely free at FlashStockSentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash does have a premium feature called Best Ideas Now. Every single week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Just scan it to download the Flash app and try it yourself, or access Flash on the web at FlashStockSentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, let's get right back to the valuation story.
Part 3. 5-year scenario framework.
We are now going to look at AppLovin through 2 distinct valuation lenses. The first lens asks a simple question: where might this stock trade 5 years from now under different operational outcomes? Now, before we jump into the numbers, I want to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is definitely not financial advice. The stock could go much higher or much lower than any of these scenarios. Here is the 5-year trajectory modeling out to fiscal year 2030. Let's focus on the base case here in the middle, which carries a 50% probability weighting in this research. This scenario assumes steady adoption of AXON Self-Serve Ads Manager among mid-market e-commerce advertisers. It projects a 5-year revenue compound annual growth rate of 20%, stabilizing at a 75% EBITDA margin. Crucially, it assumes steady cash flows will support consistent share repurchases, reducing the outstanding share float down to 280 million shares. If they hit those operational marks and we apply a 12 times exit EBITDA to EBITDA multiple, the implied share price in 5 years is $435.77. The high case, driven by massive connected TV expansion, pushes that future price all the way to $831, while a competitive slowdown in the low case drops it down to $212.
Part 4. Present intrinsic value.
So now we have 3 possible destinations 5 years from today. But there's another question, and arguably an even more fundamental one. What are the cash flows this business could generate actually worth right now, today? To figure that out, we use a discounted cash flow, or DCF, analysis. The intuition here is super simple. $1 of cash generated 5 years from now is worth less than $1 today simply because of time and risk. So we have to discount those expected future cash flows back to the present. Using the exact same base case assumptions we just talked about, that 20% revenue growth and 75% EBITDA margin, the model projects the free cash flow for the next 5 years. Discounting that at a 10.3% rate gives us a present value of $24.2 billion. But obviously, the company doesn't just disappear in year 5. We apply a 3% terminal growth rate to estimate all cash flows beyond that, discount it back, and get $66.1 billion. Add those together, subtract the net debt, divide by the current outstanding shares, and we arrive at a base intrinsic value today of $268.13 per share. But remember, a DCF is not some objectively correct magical answer. It's a way to test your assumptions. This sensitivity matrix shows how fragile or robust that estimate really is. If you demand a higher return, say a 12.5% discount rate, and assume lower terminal growth, the intrinsic value drops to around $189. Conversely, a lower discount rate with a higher terminal growth assumption pushes it up to roughly $425. So the reasonable range here sits between roughly $189 and $425, with our base case firmly anchored at $268.13. And here is exactly where the disconnect becomes visually obvious. The base intrinsic value of those future cash flows today is $268. But the current market price, even after that massive post-earnings crash, is roughly $346.80. That means AppLovin is trading at a 29.3% premium to its present base intrinsic value. Think about that for a second. Even after a 20% crash, the market is still pricing in incredibly aggressive near-term execution and the rapid scaling of their self-serve platform. So do these two independent valuation lenses tell the same economic story? Yes, but you really have to understand the timeline. Paying a premium today at $346 can actually still make perfect economic sense if you genuinely believe the company will successfully compound its free cash flows and aggressively execute its share buybacks over the next 5 years to reach that $435 future outcome. The DCF tells us what the cash was worth today. The scenario framework tells us where compounding could take the stock price tomorrow.
Part 5. Risks and final takeaway.
But compounding is never guaranteed. We absolutely have to look at the concrete risks that could completely derail both the 5-year scenarios and those intrinsic value models. What breaks this thesis? First, as we just saw, AXON execution delays. The long-term thesis is heavily dependent on these continuous machine learning training cycles. If net revenue per installation flattens out over consecutive quarters due to AI inefficiencies, those amazing margins will compress. Second, Apple and Google privacy changes. AppLovin relies heavily on probabilistic targeting. If platform owners implement stricter limitations on device-level tracking, it could seriously damage their ad matching efficiency and break their competitive moat. And finally, macroeconomic downturns. Let's be real, advertising budgets are highly cyclical. If e-commerce and consumer brands pull back their spend during an economic contraction, it directly impacts the transaction volumes flowing through that Max platform. Which brings us right back to resolving the tension we started with. The stock crashed 20% on a slight sequential deceleration because an AI-native valuation requires absolutely flawless execution from its algorithms every single quarter. When you price in a 29% premium to present intrinsic value, there's literally no room for an algorithmic pause. But beneath that short-term volatility, AppLovin remains exactly what this quote describes, a structurally advantaged software asset. The 84% margin engine remains structurally dominant. So to recap our biggest takeaways, first, this company is generating elite 84% margins. Second, trading at a premium means the market demands perfection, hence the crash over a minor delay. And third, the ultimate upside depends on them compounding those cash flows while navigating huge platform and macro risks. If you want the full research, including the complete 5-year scenario model, all the detailed assumptions, and the intrinsic value analysis behind this explainer, you can get it completely free at flash.stocksentinel.ai. So the ultimate question for investors is this: are you willing to pay a premium today for an AI engine that Wall Street demands be perfect tomorrow? Understand what this business needs to deliver, understand the assumptions driving the valuation, and watch those variables closely. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.